Welcome back to Share Navigator's Options 101. We've covered what options are, their price components, and the contract details. Now let's look at where the magic happens. The option exchange. Options are actively traded instruments, just like stocks. They aren't created just for you. They're traded on major centralized exchanges. When you place an order with your broker, that order is sent to the exchange to be matched with another trader. The main difference is complexity. A single stock, say Apple, has one price, but Apple has hundreds of different option contracts, each defined by a unique combination of strike price and expiration date. Every contract is its own tradable security, and they all live on what's called the options chain. When you look at any options quote, you'll see two key prices that define the marketplace: the bid and the ask. The bid is the highest price a buyer is currently willing to pay for that specific contract. If you own the option, this is the best price you can immediately sell it for. The ask is the lowest price a seller is currently willing to accept. If you want to buy the option, this is the best price you can immediately buy it for. The difference between the bid and the ask is called the bid-ask spread. This spread is essentially the cost of trading. If an option's bid is $2 and its ask is $2.10, the spread is 10 cents. The smaller the spread, the easier and cheaper it is to get in or out of a trade. A wide spread is a warning sign of low liquidity, meaning fewer buyers and sellers are actively participating. Two metrics tell you just how busy and committed the market is to a specific contract: volume and open interest. First, volume. Volume measures the total number of contracts that have traded hands today. If 500 contracts of a specific option traded, its volume is 500. High volume means there's a lot of current excitement and trading activity. It resets to zero at the end of every trading day. Second, open interest, or OI. OI tells you the total number of contracts that are currently open and outstanding. It only changes when a brand new contract is opened, buyer and seller both enter the market, or an existing one is completely closed. The original buyer and original seller both exit. OI is a good indicator of the long-term liquidity and overall market commitment to that particular strike and expiration. When choosing a contract, look for high OI to ensure an easier exit when you want to sell. You might be wondering, if I want to buy an option, how do I know there's always a seller ready to meet my order? That's the job of the option market maker. These specialized traders are obligated by the exchange to continuously quote both a bid and an ask price for option contracts, thereby guaranteeing liquidity. Think of them as the shock absorbers of the exchange. They stand ready to buy at the bid and sell at the ask. Their role is to ensure smooth, continuous trading, and they earn their income by capturing the tiny difference in the bid-ask spread. Without them, the options market would be slow and chaotic. When you combine the contract details, the strike and expiration, with the market mechanics, the bid, ask, volume, and open interest, you get the full picture you need for trading. When you view an options chain, use these metrics to your advantage. Contracts with high volume and high open interest typically have tighter spreads, meaning better prices for you. Join us next time as we look at some real-world option trade examples to see how we apply this knowledge to actually choosing a profitable options trade. Would you like to fast-track your learning and get daily support and follow our real-life option and futures trades? Contact us and request a free trial of our mentoring service. Visit sharenavigator.com.